Plug Power stock is currently trading at $2.84 during this live intraday session on June 16, 2026, marking an upward move of nearly 3% on the day, with an opening mark of $2.89 and a shifting trading range between $2.78 and $2.98. While a 3% daily move might prompt short-term traders to check their accounts, the real narrative surrounding this company right now has nothing to do with this minor intraday upward crawl and everything to do with a quiet, massive shift in how the company is sourcing its liquidity to survive the year. The broader market expects this company to continuously dilute its equity base through aggressive at-the-market share offerings just to keep the lights on. But the reality is that the management team has begun aggressively monetizing its physical hydrogen infrastructure assets, including a major closing deal with Stream Data Centers this month that brings in substantial non-dilutive cash. This unexpected pivot in capital strategy creates a massive gap between public perception and actual balance sheet management, forcing a complete rethink of the company's near-term survival runway. When regular retail investors look at this sector, they usually carry the expectation that alternative energy names are either speculative lottery tickets or complete money pits destined for endless restructuring. People flock to online investing platforms hoping to catch a massive macroeconomic wave, believing that policy shifts or green subsidies will suddenly turn these operations into cash cows. This general belief has burned a lot of fingers over the last 3 years as the stock collapsed from its pandemic highs down to the single digits. The contrarian take here is that the actual survival of this business does not depend on Washington passing new green mandates or the Federal Reserve cutting interest rates to zero. Instead, it relies entirely on microscopic execution metrics like gross margin improvements on liquid hydrogen delivery and physical asset sales. The crowd is watching the policy headlines, while the smart money is watching the unit economics of individual production plants. If you track recent stock movement across major online investing sites, you will notice that volatility has become the defining characteristic of this company's equity. After hitting a 52-week low of $1.03, the ticker experienced a powerful upward surge from March through May, driven by an improved first-quarter earnings report where revenues hit $163.5 million. This represented a surprise 22% year-over-year increase, which caught short sellers completely off guard. Trading volumes have regularly spiked above 40 million shares a day, proving that institutional activity and high-frequency trading desks are actively using this asset as a battleground. Institutional custody data indicates a deep division between asset managers who view the recent corporate goal of becoming earnings before interest, taxes, depreciation, and amortization positive by the final quarter of this year as an achievable target, and those who see it as corporate optimism. To understand why this price action is so aggressive, look at the contrast with other clean energy names. While retail traders using a basic self-investing app might bundle all fuel cell companies together, institutional algorithms do not. Recently, peers like Fuel Cell Energy and Bloom Energy saw massive vertical runs due to their direct connection to artificial intelligence data center power backup contracts. This company lagged behind that initial data center surge, but its recent partnership deals and asset monetization strategies are starting to close that valuation gap. When the first quarter report beat consensus expectations by 17% and showed a sharply improving generally accepted accounting principles gross margin, it changed the momentum profile. Momentum traders who usually stick to high-volume names like Nvidia stock or Apple stock started allocating tactical capital to these lower-priced industrial names to capture high-beta swings. The underlying tension in the market right now is rooted in the cash burn rate versus the timeline of asset monetization. The company has a current ratio that looks stable on paper at 2.36, but its quick ratio sits lower at 0.80, flashing a warning sign about immediate liquidity if inventory cannot be cleared. This is exactly why the company has been forced to seek investment help through alternative financing structures rather than relying solely on high-interest debt markets. The recent board modifications and executive incentive plan approval show that the company is actively trying to realign management incentives with capital preservation rather than raw capacity expansion. Institutional investors are watching this internal governance restructuring very closely to ensure that the mistakes of overexpansion made during the previous 3 years are not repeated. Let us establish some common ground on what this business actually does away from the chaotic ticker tapes of a modern trading platform. The company specializes in building end-to-end green hydrogen ecosystems, which means they do everything from producing the gas through water electrolysis to building the fuel cells that consume it. Their primary commercial footprint has historically been in material handling, providing fuel cell systems for forklifts and warehouse logistics networks used by massive retail corporations. Instead of waiting hours for a traditional industrial battery to charge, a warehouse forklift can be refueled with hydrogen in a matter of minutes, vastly increasing operational efficiency for high-volume supply chains. They also build stationary power systems designed to replace diesel generators for backup power at critical infrastructure locations. The historic financial reality, however, shows why the market has treated this stock with such skepticism. For the quarterly period ending in March, the company reported a net income loss of $245.3 million, with a deeply negative net profit margin. The cost of goods sold stood at $192.9 million, which actually exceeded the total revenue generated during the period. This means the company was actively losing money on every single unit of product that rolled out of its facilities, before even accounting for selling, general, and administrative expenses, which came in at $70.2 million. Research and development costs required another $12.1 million during those same 3 months.
This negative gross margin profile is the primary reason why short sellers have historically swarmed the stock, driving its valuation down significantly from past historical peaks. Comment below how many shares of Plug Power you currently hold, or if you are completely avoiding the hydrogen sector right now. When you look at how investors execute trades on this company through various channels, whether they are managing a long-term individual brokerage account at Fidelity Investments or executing short-term options plays on a Robinhood app, the structural platform matters. Experienced investors focusing on sophisticated technical setups often utilize an interactive broker's platform to manage their risk, leveraging advanced order types to protect against the massive 20% daily swings that this specific stock is known for. Meanwhile, hands-off retail capital flowing through a SoFi robo-advisor or a Schwab Intelligent Portfolio system tends to underweight these highly volatile individual industrial names entirely, prioritizing stable exchanged funds instead. This creates a distinct separation in shareholder composition, leaving the individual stock heavily exposed to active retail speculators and aggressive institutional short sellers. The future outlook for this company depends entirely on whether reality can finally match or exceed the long-term expectations set by executive management. The primary catalyst to watch over the next 2 months is the official finalization of the $275 million hydrogen asset monetization program. If the remaining cash from these asset sales fails to materialize on schedule, the company will likely have to return to its at-the-market equity facility, which would immediately dilute existing shareholders and trigger a fresh wave of technical selling. Another critical milestone is the operational scaling of their primary liquid hydrogen production plants. If these facilities can hit maximum utilization rates, the cost to deliver fuel to their commercial customers will drop precipitously, providing the necessary margin expansion needed to hit their positive cash flow targets by the end of the calendar year. The downside risks here are structural and severe. The company faces persistent macroeconomic pressures, including sustained high borrowing costs that make financing capital-intensive clean energy infrastructure incredibly expensive. If industrial supply chains slow down or large warehouse operators delay their transition away from traditional lead-acid batteries to conserve capital, the core revenue pipeline for material handling will stall out. On the flip side, the upside opportunity lies in the rapidly expanding market for clean backup power options within the technology infrastructure sector. As massive corporate entities build out new facilities to handle intensive computational workloads, the demand for non-diesel backup generation is growing exponentially. If the company can successfully position its high-capacity stationary fuel cells as a reliable option for these facilities, it opens up an entirely new high-margin revenue stream that the market has not yet fully priced into the current $2 valuation. Looking closely at how professional desks utilize a sophisticated interactive broker's trading setup for this stock, you see a heavy reliance on options market sentiment. Implied volatility for the company is consistently elevated compared to broader industrial averages, which means options premiums are expensive, and the market is constantly bracing for a major move in either direction. For an investor utilizing self-investing platforms to build a diversified portfolio, holding a position here requires an understanding that the company operates more like a biotechnology stock facing a binary regulatory decision than a stable industrial manufacturing business. The path forward is narrow, and there is very little room for operational error or delayed timelines. When you aggregate the analyst community across major investment reporting networks, you find a massive spread between the highest and lowest price targets. The highest estimates on Wall Street sit near $7, based on the assumption that the company successfully turns into a profitable clean energy giant as its infrastructure scales. The lowest targets sit closer to 50 cents, reflecting the view that the bankruptcy risk remains non-zero if their non-dilutive funding options run dry. The consensus currently sits at a hold, which perfectly mirrors the hesitant posture of institutional capital. Big money is not necessarily fleeing the stock anymore, but they are absolutely refusing to buy aggressively until they see consecutive quarters of positive gross margins. To close out this analysis, let us synthesize the tension between expectation and reality that defines this entire corporate narrative. The market has priced the stock under $3 based on the expectation that it is a structurally flawed business model that will indefinitely incinerate cash and dilute its investor base. The emerging reality, however, shows an aggressive tactical shift toward asset monetization, a narrowing of quarterly net losses, and a deliberate focus on unit economics over empty growth. If you are managing your capital across online investing sites, tracking these internal balance sheet changes is infinitely more important than watching day-to-day price fluctuations. The story of this stock is no longer about the theoretical future of clean energy. It's a raw, mechanical story of corporate survival and structural execution. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you for watching. Don't forget to like, comment, and share this video to support the channel.